With the US equity sector trading at all-time highs, there is a temptation to buy into the mainstream media's distorted view of its sustainability. While no one can predict the ebb and flow of the major financial indices, it is important to understand some basic fundamentals before charging full bore into the current bull market. I know that some pundits will say that the fundamentals don't matter anymore, that Ben Bernanke has engineered a masterpiece of a fiscal composition and that his successor, Janet Yellen, merely needs to keep the ship pointed in the right direction. Well, that's easier said than done, considering that quantitative easing really hasn't lived up to its stated objective. Let's be honest here. The whole point of QE was not to provide confidence to our banking system or to the litany of blue chip companies that suddenly found themselves underwater. What Mr. Bernanke intended to do was to shock the nation into growth, or to use a macroeconomic term, manipulate the Phillips curve in order to extract job growth at the expense of a higher rate of inflation. Despite all the rhetoric from the current presidential administration, the so-called improvement in the labor market has failed to address its compositional gaps. From 2008 until the middle of this year, the ADP National Employment Report showed significant job losses in the construction, manufacturing, and financial service sectors. The only area of improvement was professional and business services. However, this broad category also includes temporary help services, a euphemistic way of saying that the loss of good jobs were replaced with bad jobs. In other words, QE failed to impact the labor market on an apples-to-apples basis. And thus, we have lower growth, lower demand, and naturally, lower prices. Until the Fed figures out a way to substantively grow the economy, the current bull is really a paper tiger.